Hi there, Stephanie Counterman, the Stock Whisperer. We're here live at the New York Traders Expo 2018, and I'm really excited to have this next guest here, Robert Savage from CC Track Solutions. So Robert, tell me about risk parity. You say it is the trade of the decade. So but tell it like for somebody that has no idea what this is.
So risk parity is a fancy term used to allocate your asset portfolio. Used to be take your age, subtract that age from 100, that's the amount of stocks that you should have. So if you're 20, you have 80% stocks and 20% bonds, and when you're older like me, not quite 60, but getting there, it's almost even,
you know. Great.
Thank you, not as good as you. What risk parity is saying is stop thinking about, a formulaic bond and stock portfolio and think about things in terms of their risk and their return. So let's say you're crazy about Bitcoin. I want 25,000% return in a decade. Why isn't that the trade of the decade? Because it has 90% volatility. And 90% volatility makes you're on a roller coaster and you feel nauseous. So what risk parity does is it takes the assets in your portfolio and allocates equal amounts of risk to them based on how much volatility they have. So if bonds have 10% volatility and stocks have 20% volatility, you're going to have a few more bonds than you have stocks, but you're going to allocate them evenly. The key to the success of building a portfolio is uncorrelated returns. I don't want stocks and bonds to be negatively correlated. I don't want them to be correlated at all. So people put all sorts of crazy things into risk parity portfolios. Some people put REITs, some people put TIPS, some people put credit bonds. We make it simple. And my version of risk parity that CC Track has put together is different in two ways. One, I want daily liquidity. Why? Because you really are supposed to be harvesting volatility. Gold goes up $10, you have gold in your portfolio, the volatility creeps higher, you sell it.
Right. Does it sell for you?
And it automatically generates a daily sell or buy signal based on the changes in volatility of underlying. Right. So we live in a machine world, and I want a bunch of signals. Now, that doesn't mean that I'm useless, because I have gray hair, and every once in a while there are discretionary moments. But
you have hair.
That's important. Thank you. The key point about discretion and risk management is let's make it automatic, but then let's make it also logical. So the problem that inherently gets people upset about risk parity and why it's blamed in part for the crash that we saw in February 9th, which I think is unjustified.
It's blamed for that. You know what? We're running out of time, so when we come back, I would love to catch your answer on that. Very interesting that they would blame risk parity for that.
Everybody blames somebody.
Yeah, we'll talk about that when we come back.